What if I told you there's one tax strategy that could save you 37% on your next Bitcoin moonshot? While everyone else is panicking about crypto taxes, smart investors are using this legal loophole to keep more of their gains. Stay tuned because I'm about to reveal the only tax strategy you need for your next Bitcoin moonshot. This could be the difference between keeping your wealth and losing it to the IRS. Let's dive in. You've seen the headlines, the stories of overnight millionaires, the intoxicating promise of decentralized finance. But lurking in the shadows of every spectacular gain is a financial time bomb most investors ignore. This is the brutal, unspoken truth about crypto taxes, a reality that often doesn't hit until it's far too late, turning dreams of financial freedom into a bureaucratic nightmare. Let's start with the most common trap: short-term trading. If you buy and sell any crypto asset within a 12-month period, the IRS views that as a short-term capital gain. This means your profits are taxed as ordinary income, at the same rate as your job's salary. For high earners, that's up to 37% at the federal level. And don't forget state taxes, which can push your total tax bill well over 40 or even 50%. To put that in perspective, imagine you make a brilliant series of trades and profit $100,000. You see that number in your exchange account and feel like you've made it. But when tax season rolls around, you're hit with a bill for $37,000 or more. That's cash you have to pay, even if your crypto portfolio has since dropped in value. This is how profits vanish. But the high tax rate is only the beginning. The real nightmare is the accounting. The IRS demands you calculate the gain or loss on every transaction, which requires knowing your cost basis, what you paid for the crypto. This sounds simple, but it's a logistical catastrophe. Maybe you bought on Coinbase, moved it to a ledger, then swapped on Uniswap. You now have transactions scattered across centralized exchanges, hardware wallets, and DeFi protocols, each with its own data format. Manually piecing this puzzle together is nearly impossible. And when the IRS says every transaction, they mean it. Trading Bitcoin for Ethereum, a taxable event. Using crypto to buy a coffee, taxable event. Receiving an airdrop or staking rewards, taxable income. The IRS is no longer in the dark. They use sophisticated blockchain analysis software to trace transactions and identify non-compliant taxpayers. If your reporting doesn't match what they see on-chain, you're flagging yourself for an audit, with steep penalties for inaccuracy or failure to file, and in worst-case scenarios, even criminal prosecution. This complex system collides head-on with crypto's legendary volatility. Imagine this: in a bull run, your portfolio skyrockets and you realize a $500,000 gain. Your tax bill on that gain is due the following April. But by then the market has crashed, and your entire portfolio is now worth only $150,000. The IRS doesn't care. You still owe taxes on the $500,000 gain from the previous year, a bill that could exceed your entire remaining net worth. This isn't hypothetical. It's a devastating reality for many. We've all heard the stories of paper millionaires forced to sell their remaining assets at rock-bottom prices just to satisfy the tax collector. They won the game but lost the prize because they were unprepared for the tax tsunami. It's a bleak picture, designed to feel like success and crypto is punished. But what if I told you there's another way? What if there were established, IRS-compliant legal structures that the ultra-wealthy have used for decades to protect their assets? A strategy that allows you to defer, minimize, and in some cases completely eliminate capital gains taxes on your crypto legally and ethically. This isn't a loophole. It's a legitimate financial planning tool, and I'm about to show you exactly how it works. So you're ready for the next Bitcoin moonshot. But are you ready for the tax bill that comes with it? The difference between what you make and what you keep can be staggering. That's why we've developed a powerful 4-pillar tax strategy, designed to legally protect your profits and potentially save you tens or even hundreds of thousands of dollars. This is how you move from simply owning crypto to strategically building generational wealth. The first and most fundamental pillar is patience. Long-term holding. This is the simplest yet one of the most effective tools in your arsenal. The IRS heavily incentivizes long-term investment. If you sell your Bitcoin after holding it for less than a year, your profit is taxed as a short-term capital gain, which is treated like ordinary income. For high earners, this can be as high as 37%. However, by simply holding your Bitcoin for 1 year and 1 day, your profit qualifies for long-term capital gains rates. These rates are significantly lower, 0%, 15%, or a maximum of 20%, depending on your total income. Imagine a $100,000 profit. Selling early could cost you $37,000 in federal taxes. Waiting just past that one-year mark could drop that bill to $15,000. That's a $22,000 difference for doing nothing but waiting. This strategy not only saves you a fortune, but also encourages a healthier, long-term investment mindset, shielding you from panic selling during market dips. Pillar 2 is about surgical precision, safe harbor allocation. This involves using a specific accounting method called specific identification, or Spec ID. The default method for many is FIFO, or first in, first out, which can be a tax disaster. With FIFO, you are forced to sell the first coins you ever bought, but Spec ID gives you the power to choose. Let's say you bought one Bitcoin at $10,000 and another a year later at $50,000. The price is now $60,000 and you want to sell one. FIFO would force you to sell the first one, realizing a massive $50,000 taxable gain. But with Spec ID, you can specifically choose to sell the Bitcoin you bought for $50,000, realizing only a $10,000 gain. You sold the exact same asset, but your taxable income is 5 times smaller. This requires meticulous record keeping, which is why using professional crypto tax software is non-negotiable for this strategy. Pillar 3 is the ultimate move for significant gains, offshore strategy and relocation. This is an advanced tactic, but for those with life-changing profits, it can be the most powerful pillar of all. The idea is to legally move your tax residency to a jurisdiction that is friendly to cryptocurrency investors. We're talking about places like Puerto Rico with its Act 60 incentives, the UAE, Portugal, and a growing list of others that, in some cases, charge zero capital gains tax on crypto. This isn't about hiding money, it's about legally moving your tax home. It requires severing ties with your current high-tax country and establishing genuine residency elsewhere. This is not a do-it-yourself project. It demands careful planning with international tax attorneys and financial advisors to ensure you are 100% compliant with the complex rules of both your old and new home countries. When executed correctly, it can legally reduce your tax bill from millions to zero. Pillar 4 turns market volatility into a tax advantage. Tax loss harvesting. This strategy allows you to sell cryptocurrencies that are at a loss to offset the taxes you owe on your gains. What makes this uniquely powerful for crypto is the historical absence of the wash sale rule that applies to stocks. While you should always verify the current regulations, this has traditionally meant you can sell a crypto for a loss and buy it back almost immediately. Here's how it works. Say you've realized a $20,000 gain on Bitcoin. You also hold some Ethereum that's currently down $15,000. You can sell that Ethereum, harvesting the $15,000 loss. That loss directly offsets your gain, so you now only owe tax on $5,000 of profit. Then, you can immediately repurchase the Ethereum, maintaining your position in the market so you don't miss a potential rebound. You've effectively kept your portfolio intact while generating a significant tax deduction out of thin air. When you combine these 4 pillars, you build a comprehensive tax shield. This isn't about using one trick, it's about creating a holistic system. You use long-term holding for your core position, tax loss harvesting to manage volatility, and specific ID to optimize every single sale. For those who qualify, relocation is the final powerful capstone. This is the difference between paying $37,000 in taxes on a $100,000 gain and potentially paying $15,000 or even zero. This isn't tax evasion, it's tax intelligence. It's using the government's own rulebook to your advantage, just as the world's wealthiest investors have done for decades in traditional finance. And the best part? Every pillar is completely legal when executed with precision and professional guidance. As Bitcoin's value continues its long-term journey upwards, the stakes get higher, and the value of this strategy multiplies. By implementing these pillars, you're not just hoping for a moonshot, you're building the rocket ship that ensures you bring the profits back home. But we're not done yet. The strategies we've covered are essential, but now we're entering the masterclass. These are the bonus tactics savvy crypto investors use to not just save on taxes, but to build generational wealth. Ready to level up? Here are 3 powerful tactics that can transform your financial future. First, the ultimate tax shelter, the Roth IRA. While standard Roths don't allow crypto, specialized self-directed IRAs or SDRs do. The magic is simple. You contribute with after-tax dollars, so every dollar your crypto earns grows 100% tax-free. At retirement, all of it, including massive gains, is yours to keep with zero tax liability. Imagine turning small annual contributions into a seven-figure crypto portfolio over time, and paying no tax on the growth. This is one of the most powerful long-term wealth-building tools available. Next, let's talk about legacy. When you've built significant crypto wealth, you don't want estate taxes to wipe it out. This is where strategic estate planning using trusts comes in. By placing your crypto into a specially designed trust, you create a legal framework that protects your assets. This can minimize or even eliminate hefty estate and gift taxes. It also allows you to control how and when your heirs receive their inheritance, protecting the wealth you built. It's about ensuring your digital assets become a lasting legacy, not a giant tax bill. Finally, for active traders and miners, operating as a sole proprietor is inefficient. Tactic 3 is to form a corporate structure, like an LLC or S-Corp. When your crypto activity is a business, a new world of deductions opens up. You can write off expenses like high-performance computers, trading software, and internet bills. Depending on your situation, you might also benefit from lower corporate tax rates or qualify for trader tax status with the IRS for more favorable treatment. This strategy transforms your trading into a legitimate tax-optimized business. Now, a crucial word of caution. These are highly sophisticated strategies. Navigating self-directed IRAs, trusts, and corporate tax law is not a DIY project, especially with crypto's complex and shifting regulations. It is absolutely essential that you partner with a qualified tax professional, a CPA or tax attorney with demonstrable crypto experience. This is not tax advice. It's a roadmap of what's possible. With expert guidance, you can confidently implement these advanced strategies, turning a potential tax nightmare into a powerful wealth-building machine. If this video just saved you thousands in crypto taxes, smash that subscribe button and hit the notification bell. I've got 2 more videos dropping this week that dive deeper into offshore strategies and Roth IRA tactics. Drop a comment below with your biggest crypto tax question, and I'll answer it in the next video. And if you found value in this strategy, give this video a thumbs up to help other crypto investors find it. Remember, wealth protection meets moonshot psychology. I'll see you in the next video where we're going even deeper into crypto tax optimization. Until then, keep building your empire and keep protecting your gains. This is ETF Empire, signing off.